Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me remotely, we have Brian Joyce. He's the Managing Director of Nasdaq's Market Intelligence Desk. We're going to take a look at some of the technicals in the market. And is a bear market rally underway? Brian, of course, that's the question on everyone's mind right now. Have we bottomed out? What's the VIX saying? What are technicals saying? There's still a lot of chop in this market, despite the fact that we've been green over the past couple of days.
Yeah, there certainly is a lot of chop in this market, and I don't think that is going to go away anytime soon. So after 28 or 29 days straight without two consecutive days in the green, we've now strung 3 days in a row together in the green. That expectation of the stimulus package has come through. And so there's been just a lot thrown at this, massive coronavirus problem by the regulators, by the full horsemen, by Congress, by the Fed, by the SEC, and other regulators. And so a lot of expectation is when we come out of this, how is that going to impact the market and have things running from here? But we're far from out of the woods. Obviously, there's a lot of uncertainty regarding the virus. And most importantly, because we had such a dramatic decline, a 35% decline in less than 6 weeks, just over 5 weeks, the ranges that we're going to see ahead are just going to allow for many, many different possibilities for corrective waves, whether they're triangles, whether they're flats, whether they're zigzags, to go up and down and all around. So the absolute low from this correction could potentially already be in. But I do think at some point in the near future, or the intermediate future, I should stress, we're likely to at least come close to retesting those lows. There is certainly a possibility we could have a V-shaped move higher, but that's not my base case expectation at this point in time.
All right, let's take a look at the bonds before we go into stocks. And here our first chart, we're looking at negative yields. I mean, this is unprecedented. This has never happened before, right?
Correct. So, this is one reason why, investors who, are jumping into equities and other risk assets right now should just keep in mind that what's going on in the Treasury market, could be a yellow flag. And so what we're seeing as a result of the impact of the coronavirus on the U.S. economy, the global economy, such a strong demand for risk-free assets that we're now seeing the 1, 2, and 3 month Treasury yields as well today as a 6-month maturity, now all below the zero level. They're all in negative territory, something we've never seen before. I think maybe briefly in 2015, there was a day or so where part of the curve went negative, but for the most part, this is the first time. Earlier this week on Monday, we even had the 12-month yields dip negative on an intraday basis. So those forces of deflation all around the globe and the uncertainty as to what the future holds regarding the coronavirus is really driving demand to the very short end and the belly of the Treasury curve.
All right, if we move along to our next chart here, this is the 2-year. Are you starting to look at a little bit of consolidation here?
We are. So you see this phenomenal move to the downside from February into March. We were around 135 basis points, 165 if you go up to, say, the beginning part of 2020. And we dropped all the way down to 25 basis points. And that was in early to mid-March, about 2.5 weeks ago when we first bottomed there. So you could see there's support at 25 basis points, and the top of the range is about 54 basis points. And that's now the sideways consolidation following that dramatic downside move. Going back to what we just looked at, we see now the 1 month all the way up to the 6 month and briefly the 12 month all went negative. My concern is that the 2-year is going to break support to 24, 25 basis point support and move further to the downside. And, hopefully it doesn't join the other maturities on the shorter side into negative territory. But that's the risk that is certainly on the table right now.
All right, and moving along to the equity side of the equation, we'll pull up our first chart here. It's the S&P 500 on a 60-minute chart to get a little bit more of a shorter-term look.
Yeah, we've been trying to look at it on the zoomed-in short-term look, just so we could get a good feel as to the movement of the index, and the daily candlesticks are just not showing us enough volatility and price action, given how dramatic things are moving around. So this is just showing us the third leg down from the high made back in mid-February. So we had a 16% move down over the first 7 sessions of this decline from mid to late February. We then rallied back 10% into March 4th, and that's where this trend line begins. This chart begins. This here is showing the third move, the second move to the downside, wave C, we could call it. And this move was a 30% decline. Overall, top to bottom is 35%. What we're looking at here is that third leg to the downside, wave C, the 30% move down. And it bottomed on Monday on the 23rd. We had a little mini double bottom in yesterday's session. We came back to the upside. And on Tuesday, on an intraday basis, we got back above that gap line, which is the white dashed horizontal line, 2474. On an intraday basis, it got above there. Tuesday, actually, this is probably yesterday's opening. And it was unable to sustain that breakout. It pulled back. And then later on in yesterday's session, it did move higher above the gap line, 2474. And we have been noting last week, the last couple of times we've been talking, Jill, that the gaps on the way down have proven to be resistant. And this was really the first meaningful gap that we see the S&P break out back above. It did pull back yesterday to that gap line. So the prior resistance now acting as support. And from here into today's session, the S&P did move higher. So by looking in at the really short-term movement, the price action, those waves, you can see there's a story there and risk levels that you can pick up. So if you're looking to get involved here, which is, something that you want to have experience in doing, if you're going to be day trading and swing trading this market, what's important is you can identify what your risk levels are before entering your trade.
All right, and to wrap up with our last chart here, we'll take a look at the S&P 500 on a weekly chart. What are you getting there in terms of a longer-term look?
So if we can finish at these levels or higher to close out the week, this is going to be good for the near to intermediate term. What this is telling us is that we bounced off the bottom, and we're now, well, first of all, the weekly candlestick pattern, this big green candlestick for this week's price action has completely engulfed last week's candlestick, the red candlestick. So that's a common bottoming pattern that we call a bullish engulfing candlestick pattern. It's a 2-week pattern in this case. And so where is the upside target? So what I did was I just drew some Fibonacci extensions from the entire 35% move to the downside, and then the 38.2, the 50, and the 61.8 retracement levels. Those are my guidelines to see where the S&P could potentially go. Now, I just was looking back to 1987 when we had this similar type of dramatic decline. Back then, we declined 35% in about 3 weeks. So almost about twice as quickly as we did this time around. Back then, we didn't have the circuit breakers like we had now. We triggered about 4 circuit breakers during the decline of the last 5 or 6 weeks. Back then, we didn't have those circuit breakers, and maybe that's the reason why it was able to make that similar kind of percentage move in about half the time. But the relief rally in 87 did not even make it back to the 38.2 retracement. It came just shy of it, which is kind of where we are right now with the S&P. We're just a little shy of that 38.2 retracement at 2650. I think we peaked today around 2602. So, every time is different. History sometimes repeats, but it doesn't necessarily mean we're going to stop right here. We could go up to the 50% at 2792, all the way up to around the 29.25 level, which is where the 61.8% is. All options are on the table. These are just kind of signposts to look towards as potential resistance levels. I do think at some point, though, that this relief rally will run its course and we'll have a rollback over closer towards the downside. But that could take weeks and weeks. So we'll just have to track this and see how this goes.
All right, Brian. As always, appreciate the insight. Thanks so much for joining us.
Thanks for having me.
All right. And thanks for joining me on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.